when the Fed starts moving interest rates, right, they only control the short end side of the Fed funds rate, the short end of the curve. But what the rest of the curve will do, the 10s, the 20s, the 30s, will start to adjust based off of the interest rate movements that the Fed is doing. So the fact that they started to expedite that movement, all of a sudden it put greater pricing pressure within the 10s, 20s, and 30s. I mean, look at 30-year mortgage rates now.
I know, they're almost 6%.
Yeah, I mean, you've jumped over 2.5% since the beginning of the year. So all of a sudden, that home that you wanted to buy at $500,000 home just became a whole lot more expensive if you're going to borrow in a 30-year loan.
Right.
Same thing with a 10-year bond, right? As these rates go up, it puts pricing pressure on them.
Well, here's the question, though, Brad. Here, I think that I want to go back to the Fed and to the overnight rate that you talked about. That's the short end of the curve, right? So what are the chances that the Fed gets to its 3 to 3.5% overnight rate by the end of the year, which is what they're talking about, and we don't see more upward movement on the 7s, the 10s, the 20s, and 30s?
Then you're just pushing us right into recession, right? I mean, you're going to invert the yield curve even more dramatically than it is today. And maybe that's okay. Maybe we're already in recession and the Fed has a little bit of room to continue to drive us into it. But I'd be careful with some of that, right? First of all, the markets are trying to price in 6 to 12 months in advance at any point in time. And right now they're pricing in that you're going to have another 75 basis point movement in July and probably another potentially 75 basis jump in September. Now, if those play out, that's going to put us pretty darn close to that 3% target that they're looking at. So between now and then, what kind of action are we going to get on the 10-year Treasury? Because if it continues to collapse, I'm going to argue that I think it backs them in a corner where the odds of the 75 basis point rate hikes start to go down. And if you want to know my personal opinion on this, I think we have one more rate hike. And if we see a softening of inflation, I think they're going to cool their stance a bit. I don't think they're going to get out of the game of continuing to try to normalize, which, by the way, Powell was on a great path to normalization before COVID hit, right? And in fact, in 2018, we kind of hit the high of that normalization process. And what happened back then, we watched the 2s and the 10s get darn near close to inverting. And so the Fed stepped in and said, hey, we ran too far, too fast. We got too hot. And what they do, 2019, they were actually cutting rates going into 2020 when COVID hit and we went to zero interest rate policy. So I share that because there's a lesson that I think Powell probably learned during that time frame of there's a balancing act of not just killing the overall economy, but the difference between now and 2020 is a 9.1% inflationary print that we're dealing with today. That has to be the primary mandate of the Fed.
That's right. And I, I guess my question to you is, what is your outlook for, let's just use the bond aggregate as a whole between now and the end of the year? How do you think that plays out? Because the yield's not great yet. I mean, quite honestly, I can go buy a 1-year Treasury and I can get a better yield than buying a bond aggregate.
So I think the Barclays U.S. Bond Ag ends the year better than where we're at right now, right? I mean, there is a benefit of that coupon clipping along. If we can just get some stability out of the 10-year, and I think you're starting to see it, right? We've been up to as high as 3.5. The last 2 times we've been up to 3.25 on a 10-year, and it starts to hit this pretty strong resistance level and has a tendency to find its way back down. I don't think it's going to break above that 3.25 until we get some clarity of how far this Fed is really looking to run. And right now, I think the bond markets are pricing in that the Fed has to stall at some point within the next couple of meetings.
And that's because of the slowing of the economic activity. But again, I think you've got where I am concerned is that the inflationary numbers, the inflation, the pure inflation itself, is harming the vast majority of Americans far more than a bad bond market or a bad stock market is harming the wealthy people. It's causing them to not be able to do the things that they want to do. The discretionary spending, we've seen that decline substantially over the course of the last several months. And so I think the Fed really has to be aggressive to kill inflation because, as we know from the late 70s, early 80s, you can have runaway inflation with a stagnating economy for a long period of time.
Yeah, and there's a scenario where stagflation plays out, right? the probabilities of it are still fairly low at this point, but they seem to be increasing every single month. So, but let's go back. The Fed has a primary mandate. It's protect the value of the dollar and keep inflation in check. A third kind of loose mandate is making sure they keep unemployment in line to some degree. So
two of those things they're doing a pretty good job at.
Yeah, unemployment still looks really good, which is why I think you're going to get a lot of banter that goes back and forth. If we get a negative GDP print here in second quarter, which would be the textbook definition of a recession, right? 2 consecutive quarters of negative GDP growth. I think the narrative that's going to come out by a lot of economists and market specialists are going to be, yeah, this isn't a real recession. Well, you can't move the goalposts on the definition of what a recession is, right?
I read something about that here last week where somebody's saying, well, this can't do, even if we have negative GDP, this isn't going to be a real recession because, people are still doing well. We got low unemployment, and you can't have a recession with low unemployment. And it's like, well, you can still have negative GDP growth,
sure, which
is the definition of a recession.
Well, and if you kind of go to their core thesis with all of this, it is really this recession is not necessarily an overheating of the economy. It's really the sheer amount of money that we've pumped into the system over the last decade, right? And to that point, I get it. And I think we addressed it on the last show. We said there's a scenario where if you were to remove the backstop of the Federal Reserve and the massive amounts of money that they've pumped into the bond buyback programs back in 2020, if you start to remove the stimulus checks that everybody was getting during the pandemic, where does this market go? And we're seeing it, right? When you dry up some of that capital, all of a sudden reality starts to set in.
Starting your route to retirement.